Ken, your thoughts on that? Is it or isn't it QE? Weigh in on that debate, please.
Well, I know Mr. Kashkari is trying to throw cold water on the idea that it's not, but I'm not sure even being in Minneapolis, he's got enough cold water to throw to convince the market that it's not. I think the market's call is correct on this.
Why do you think the market's call is correct on this?
Well, I get his point, which is that they're just substituting one short-term instrument for another that's risk-free. But the way the market's looking at this is providing more liquidity, and that liquidity to the market is obviously driving prices higher for risk assets.
Well, let's take that tweet from Neil Kashkari and put it on the screen, shall we? Neil Kashkari, the Minneapolis Fed president, writing the following. QE conspiracists can say this is all about balance sheet growth. Someone explain how swapping one short-term risk-free instrument, reserves, for another short-term risk-free instrument, T-bills, leads to equity repricing. I don't see it. Lisa Hornby.
I think you just have to look at the market and say, look, it doesn't matter whether you believe it or not. Markets have reacted to years and years of liquidity being poured in by central banks around the world, and this is another example of it. Whether Neil Kashkari wants to say it's true or not, I think that the market has spoken for itself. We're at equity all-time highs. I mean, once again, bonds can't even sell off a few basis points, and we're at all-time highs on the equity market.
Chairman's Powell argument would be if there's no forward guidance, it's not QE, but unfortunately the perception of the market is the reality, and the real question will become in February is let some of that term repo roll off. Do we reverse in the markets?
Is that the ultimate point here? Perception matters. So long as enough people think it is, that's all that matters right now. Is that where we're at?
I think that's where we're at right now. It's setting the tone of the markets for all of 2020. We're coming off a great 2019. This is setting the tone for 2020.
You agree with this, Ken?
Look, it's like watching the Fed dots, okay? The Fed dots may be in a very different place than where the market is. And I think that the market's judgment's correct. The Fed may be saying one thing and may be trying to guide in a certain way, but the market's taking its actions completely differently.
One crack in the resolve of the Federal Reserve this week, and it came from the Dallas Fed President Robert Kaplan speaking in an exclusive interview here at Bloomberg. Take a listen to what he had to say.
There's three aspects. There's one, rates are lower. Then there's a perception that the bar is higher for future rate increases. And then the third issue is in order to address this repo issue, we've grown the balance sheet. All three of those actions are contributing to elevated risk asset valuations. And I think we ought to be sensitive to that at the FOMC, and I certainly am.
Lisa, here's the issue for me at the moment. This audience for this programme, incredibly sophisticated, and I imagine a large proportion of it will take the view of Neil Kashkari. Is there a risk, though, of being too smart about this problem right now, if we can call it a problem, and the read-through from what the Fed is doing into broader financial markets?
I mean, I think the risk is that markets have become accustomed to this liquidity, and whenever the Fed tries to pull it away, they create problems. I mean, we saw that at the end of 2018 and the beginning of last year, they literally had to reverse the hiking cycle. I mean, at the end of the day, growth didn't change that much. Yes, we had fiscal stimulus-induced strength in 2018, and certainly it came off in 2019, but we're still at 2% growth rate. So it wasn't necessarily a growth problem, it was a markets problem. And I think the Risk Bank has alluded to this. Monetary policy cannot solve all ills of the market, and that's why they're beginning to pull back. I mean, we are conditioned now to believe central banks will solve everything. We only have 175 basis points of rate cuts to go in the U.S. before we're at zero. So they have to be very careful in the messaging, but equally, whenever they try to pull back, markets react very negatively, and then they're forced back in.
We've been conditioned by these central banks who are doing this. And Ken, I think that's worth exploring, that maybe the Federal Reserve's missing the broader picture here. There's a huge green light on to take risk in financial markets. And the Federal Reserve is shining that ever brighter. Effectively, the message they've sent is that the economy this year is okay, the economy is in a good place, and even if it gets better, we're not pulling back. But if it gets worse, we'll step back in. We'll be ready to do even more. We're going to spend a lot of time talking about credit and perhaps the risk talking about credit in, say, triple Cs, leveraged loans a little bit later in the programme. But at the moment, is that the broader picture that you think the Fed might be missing at the moment? That they're flashing a massive green light to say, load up on risk?
I think that's exactly what they're doing. That may not be the intended message, but I think that's exactly the message the market's taking away from it. The Fed's going to have a very, very difficult time weeding the markets off this concept of they're going to be constantly stimulative. I don't know how they're going to get that done.
Greg?
I'm not sure there's a better policy. You might be arguing that they're making a policy mistake by being too soft, too dovish. But what would be the alternative? As we've pointed out, Lisa pointed out, if they are a little more hawkish, the markets react very, very negatively.
Well, I don't want to spend too much time talking about what the Fed should or shouldn't do. I just want to talk about what it means for capital markets. You mentioned treasuries. Yields have hardly moved. 180 on a US 10-year. Even though credit has rallied really quite nicely, equities ripped over the last 12 months, and here we are, 180. Why?
I mean, honestly, if you had asked me a couple of weeks ago, I'd say that we probably should be a little bit higher in yield, not aggressively so, but obviously this tells us something about positioning and demand for treasuries and U.S. fixed income. It's still out there. And, I think that tells you we're probably, the sell-off, if there is one, it's going to be very muted. It's going to be bought.
Ken?
I think treasuries are run about as far as they're going to run at this point. I do think that if we do see some improvement in growth, we're looking for improvement in growth in Europe, for example, that the message will be the market's going to be adjusting for that at some point. Are we going to go dramatically higher? No, but I think we're probably at the low end of the range.
I think we're getting that already. It's almost like Chinese water torture on the top of a treasury at the moment. Just drip, drip, drip of OK data from the United States. Housing starts ripping to close out this week. Chinese data doing OK. That Chinese data to close out the week was really quite terrific compared to what we had 12 months ago. Here we are, yields up by what? A basis point?
Right.
Does that make sense?
I would argue it should have moved more, but there's obviously this tremendous damper on the system that's the Fed, and I think that's what you're seeing right now.
Greg Staples?
ECB is still supporting with 20 billion of euros, and in their version of QE, that's supporting it on one end. Seems like the market consensus is the Fed's completely out for all of 2020. That leaves you with a 10-year at 180. Break evens, 175, real yields, 5-10 basis points.
Yeah.
I don't see anything breaking us out of here.
We've got to talk about the Treasury getting back in as well. A 20-year issue coming to market. My question quite clearly is whether the average duration is looking to be pushed out here by the Treasury, Lisa, or whether they just take some out of the 30, put it into the 20, rob some from elsewhere as well. How do you see that evolving in the coming year, the average duration of the Treasury?
So, first of all, I think it would be smart for them to increase the duration given how relatively flat and low yields are. In the near term, they might try to do some tweaks because they don't need the funding this year, but they need the funding next year. So whatever they do this year, I think will be temporary, just to try and get the issue well absorbed. I think next year we'll see normal auction sizes in the 20-year. I think this will be a consistent part of the curve for as long as we're in markets.
Was that a signal then for a steeper curve from the Treasury?
I believe 100% it was. I mean, I've been on the show talking about this very topic. They should have done 20 years. I think they could even do longer debt at some point. It will be bought. There's clearly demand. There's no question about that. But I do believe that the Treasury and the Fed and central banks truly around the world want steeper curves. They realize what happens when the market gets itself into an inverted curve cycle and how bad that is for growth and future prospects. So I think that they are doing everything they can. Buying bills is one way to steepen the curve. Issuing 20 years is another way to steepen the curve. These are all slight tweaks at the margin, but they need the funding. Curves are flat. Why not?
Greg Staples?
There is demand for it. You talk about LDI, the liability-driven investments, long insurance companies. I think it's going to be very well accepted within the marketplace. And when the Treasury sees that, there'll be more issuance there.
Final word, Ken.
Go long.
Go along a steeper curve?
Yeah.
That it? Short and sweet?
That's short and sweet on that one.